Well, Manar, it feels like not too long ago we sat down on a podcast. Welcome back.
Yeah, I appreciate you having me here again, Rob. This is a topic I'm excited about.
Well, it certainly is a wonkier topic. So fair warning to our listeners, we are going to get into some detail on a topic that might seem pretty plain vanilla on the surface, which is that of position sizing. How big a weight to ascribe to a single position in a portfolio. And so, Manar, I first heard you talking about this specifically, this deep dive, at our top-down scenarios forum that we do as a research team. And I'm wondering, can we start there? What is that? What does it involve, and why do we do it?
Yeah, so we're a decentralized team at Mawer, and curiosity is an important pillar of our culture. And so when you think of the top-down scenario forum, this has really become an annual tradition at our fall retreat. Our research team members get together and we explore kind of economic scenarios, themes, trends, related investment topics. And you can share those ideas in kind of a free-form presentation. So written, PowerPoint. I'm a big PowerPoint guy still. But look, we're bottom-up stock pickers, and we intend to kind of stay that way because that's really where our competence and our value add lies. But this is an opportunity for us to practice our top-down thinking, really try to harness the creativity of the team and get those neurons kind of bouncing and colliding between the team, right? And I've had great conversations coming out of this presentation. And the ultimate goal is to try to improve, the inputs into us making repeatable good decisions. And so that's where this top-down scenario form kind of is involved.
Yeah, I've heard it described as just an opportunity to help us stretch, go outside our comfort zone a little bit, and talk about something that we do a deep dive on. Now, yours is less of a macro topic, but it is a broader topic. And I'm just wondering, how did you land on this idea of position sizing as something to spend a lot of time on researching?
Yeah, and this is fascinating. So Michael Mauboussin has this great paper, and he talks about there's only two ways of really generating alpha, Rob. And one is you have an edge, and two is through position sizing. And I became kind of really excited about this topic because I immediately thought, well, position sizing is this kind of squishy thing which can generate money for our clients, but it seemed like the topic was usually an afterthought. There wasn't a lot of kind of attention paid to it, especially relative to the binary kind of yes or no decision like buy or sell. And that seemed to me like an inefficiency or a missed opportunity. And then I also thought, well, how do I reconcile all this with great investors like Warren Buffett or Charlie Munger, Ed Thorpe, Druckenmiller? They all emphasize to some degree or another that betting bigger when the odds are in their favor is something that they ascribe to. And I think I recently heard Druckenmiller talk about, what he learned from George Soros, and that's that 70 to 80% of the equation is position sizing. And one of the key things was to size bigger, or go for the jugular. He said, when you have the conviction, and so you have all these great investors telling you that position size matters, while there's kind of little attention paid to it. And I think the combination of these things kind of piqued my curiosity. So I set out to really survey the landscape. Really, what I'm trying to do here, Rob, is stand on the shoulders of giants and put together a mosaic of the different perspectives, and then apply my own judgment and framing along the way to Mawer's process. But think of this as an open-ended exploration of the topic and me just trying to grapple with it.
Okay, perfect. Well, I'm glad, you mentioned Ed Thorpe. I'm glad you said that you didn't get interested in this because you were a degenerate gambler. And I mean that somewhat half facetiously. There are concepts that we'll discuss here today that originated from gambling principles and were applied in that format in the first place. As time has gone by and investors have seen, like Warren Buffett, have seen their utility, they've applied them to the stock market as well. So you talked a little bit about why position size matter. And I think, just to a layperson like myself, it seems to make sense. If if something's going to return a lot, apply a higher weight to it. But I wonder if you can get just a little bit more granular with respect to some of the underlying reasons why position sizing might matter too.
Yeah. Sorry to disappoint you, Rob. I do, with my wife, I always say, hey, you want to bet? So I just won $20 yesterday, but I realized it's all in the same pool. So what's the point? But look, if we think about it from first principles, I think it's actually a very important question. One reason position size matters is behavioral. And so, for example, your entry size kind of often matters more than the entry price, because your size is a key determinant of your ability to stick with a winning position. So let me give you an exaggerated example. Imagine you had 100% weight in one stock and it loses 50%. Well, you just lost 50% of your portfolio. Versus if you had a 1% weight and you lost 50%, well, you lost 0.5% of your portfolio. And so I suspect, Rob, you'd feel a lot more sanguine kind of psychologically if you only lost 0.5% of your portfolio, and you may be a lot more open to doubling down, evaluating the facts more rationally, and not pass up on potentially a great opportunity.
Okay, so your point is that behaviorally, in time period one, where you get that drawdown, even if the investment, of course, you'll never know this, but even if the investment were to turn out to work out and then rebound quite strongly after that, you're saying that a larger position size increases the behavioral odds that I'll just give up and settle the position entirely, as opposed to sticking with it.
Yeah, I think you're spot on. I mean, there's a lot of emotional damage, and it's much more difficult, I think, from a resilience standpoint, to be able to take a look at that and not question your judgment, so to speak. And there's an interesting, concept that traders have they call the uncle point. And that's the point you kind of throw in the towel because you just can't suffer the pain anymore from the drawdown. And so getting that position roughly right may let you not throw in that towel and maybe squander a winning investment.
Okay. Is there something about the structure of markets, too, that leads to this idea that position sizing really matters?
Yeah, I think so. Another reason that the position size matters is because we can amplify our returns. But let me step back first about the structure. Stock markets are fat-tailed. And so they have this power law distribution similar to wealth. I mean, there was a good research paper on this. Over 90 years of U.S. stock market data showed that only 4% of all listed U.S. stocks explained the net lifetime dollar wealth creation. And the remaining 96% collectively just matched the returns of a 1-month treasury bill.
That's pretty wild.
And that just astounded me. And here's another fun way of looking at it, courtesy of Nassim Taleb. He makes a technical observation that 1 year of data out of 56 years up until 2009 explained roughly 80% of the S&P 500's kurtosis. And so that's a measure of the tailedness of the distribution. I know you had a disclaimer up front. We're going to get into this. So we really are. So if you took out that one observation, your whole distribution changes. And so imagine, Rob, I like to think of it like this. You walk into a bar and there's 21 people. You go around calculating the average wealth and you get 10 billion. You think, wow, this is a really wealthy bar. I was
going to say, you hang out at different bars than I do.
Well, but 10 minutes later, one person walks out and you go around recalculating the average wealth and it's only $100,000, which is the median U.S. wealth. And you're shocked until you realize the person who walked out was Bernard Arnault, the chairman and CEO of LVMH, the richest person in the world. And so you completely change the properties of the distribution. And it's the same thing if you took Warren Buffett out of Omaha, look at the distribution of wealth and how that changes.
Got it. Let's go from kurtosis to something that is perhaps a little bit more relatable for listeners like me. Baseball. There's a lesson from baseball here too.
Yes, yeah, absolutely. So our goal is to have bigger weight in the right tail events. Let's go the winners, and the smaller weight in left tail events, the losers. So it's about how much money we make when we're right versus how much we lose when we're wrong. But we often kind of think about a lot in probability or frequency space instead of an expected value with kind of payoffs or magnitude. So let's think about baseball. In baseball, we have the batting average. And the batting average is kind of how many times you actually hit the ball relative to how many times you went on at bat. Whereas there's another one where there's another statistic called slugging percentage, and that tries to differentiate between the hit produced by taking kind of the total bases of a hitter and dividing that by the number of at bat. So, for example, a double or a home run should have more weight, right? You had 100% stock return is more valuable than a stock with a 20% return. But the batting average won't take that differential into account.
So you're saying that the slugging percentage is probably a better measure of the utility of the batter, and there is an aspect of sizing that's embedded in that slugging percentage, which is not in the batting average.
Yes, I think they're both very useful because if you can improve your batting average, that's still good, right? That means you're more,
Yep.
usually the odds are on your side, and as you think the probabilities are. So your hit rate is better. But there are a lot of great investors where their hit rate is below 50%, but they still make a lot of money. And it's really a result of how much money they make when they're right versus how much they lose when they're wrong. And in investing, we can really take this one step further, Rob, because we can amplify our returns through position sizing. So we can get 1,000 runs, where in baseball it's capped at 4.
Right? Oh, I
Right?
see. Yeah.
Right. It's Jeff Bezos talks about this in business as well for Amazon. It's that's 1,000 runs, right? Where it's capped at 4, the slugging percentage in baseball. Of course, the challenge is ex ante. We, beforehand, we don't know the significance of that skew or that result, and that's kind of revealed to us in the long term. That's the challenge for everybody, but this is just theory.
We'll get into that a little bit later. Let's actually go into the theory, though.
Yeah.
And I, like I said, I was serious. This does emanate from the world of gambling. Let's talk about Kelly Criterion, because I think this formed a big chunk of the work that you did.
Yeah, let's talk a little bit about the development of it, and then we'll go kind of more into the actual formula. Kelly takes information theory and tries to extends it to gambling. And humbly, Rob, there's a lot of math that's above my pay grade in this, but the book, I think, Fortune's Formula, does a great job explaining this. What I find interesting is the premise that true information is unpredictable. So think of a series of random events like rolls of a dice. And I thought the book example is pretty funny. Your spouse tells you to bring home shampoo, but instead you bring home Shamu, the killer whale. And that's a pretty ridiculous misunderstanding, Rob, because if your spouse wanted you to bring home a killer whale, I suspect it would be highly likely that it would come with a lot of explanation as to why.
What? Why? How?
Exactly. And that requires more bandwidth. So that's kind of partly the link to information theory. But how do you link money to information? Imagine I sent you kind of a 0 or a 1. So that's a single bit. Mm-hmm. And I told you for sure that the Kansas City Chiefs are going to win the Super Bowl at even odds. So I told you 1 means they're going to for sure win. I suspect you'd say that bit of information is worth a lot of money.
Okay, so you're Joe Biden, basically.
Yeah, I got all the power. I'm a little bit younger, Rob. I have to admit. But anyway, there are many iterations of the Kelly formula, right? But the most basic and intuitive one, at least to me, boils down kind of to the optimal fraction of your bankroll you should bet. So the percent of your bankroll. So if I had $100, what percent of that $100 should I bet? Will depend on your edge over your odds.
Okay.
And edge is, how much do I expect to win if I could make the same bet over and over again? And odds is kind of measuring how much your profits you would actually make if you win.
Okay, so those are the two critical components.
Yeah.
And I'm guessing that as your edge increases, the more you should bet. And as the ratio of what you win versus what you lose increases, you should be more willing to bet more of your bankroll.
You should bet more of your bankroll. I mean, it's trying to solve for the optimal. So it's actually saying, hey, this is the optimal amount. Again, we're working in the field of theoretics right now, and then we'll break it down into more practical terms later. But yeah, you're spot on. And it also says, hey, if your edge is 0, well, 0 over, so you should bet nothing, right? So if you have no edge, bet nothing. But there are two central questions that the kind of Kelly Criterion asks. One is, what level of risk leads to the highest long-run return?
Okay.
And what is the chance of losing everything? So what it's trying to do is maximize the compounded growth rate of your money without taking any risk of ruin. I love that because philosophically, what it's emphasizing is survival, right? So it's like, hey, maximize my return subject to surviving, right? So and one of the reasons, if you all held all constant, is if you bet a kind of a fraction less than 100% of your bankroll, right? So you think of a percent of your bankroll, you should theoretically never go to 0, because a percent of something should not go to 0 as long as it's not 100%.
Got it. But let's go back to one of your examples from earlier, where you talked about, if you had a 100% position in something and it went down by half.
Mm-hmm.
Well, I guess Kelly's saying never put 100% of your position in anything. because there are probably no 100% for sure bets. But even if you had like a 90% probability on something, I presume that if it got cut in half, that would still be uncomfortable. As you apply Kelly to what you do, which is finding companies and deciding what weight to ascribe to them, what are some of the pitfalls or things that you think are maybe a little bit different in investing versus gambling?
Yeah. And Rob, so the Kelly might tell you, hey, bet 100% plus. It depends on theoretically how much if your edge is so perfect, et cetera. But you're right. I mean, there are fragilities in optimized systems, right? If you look at just-in-time supply chains, and then the pandemic hits, right? Well, what happened? Well, that exposed the fragility in just-in-time, which is a highly efficient supply chain. And one of that fragility with Kelly is kind of volatility, and that's not specific to the stock market. Now, it's nice theoretically, Rob, that you won't go broke. But you're right. I'm not so sure you'll be happy losing, 95 or 50% of your bankroll. And so the optimal allocation leads to a lot of volatility, and it's difficult to stomach those drawdowns.
And probably just increases the chance of behavioral error associated with that too.
Yeah, exactly. And there's a nice Nassim Taleb graph I've seen in his technical inserto, and he shows a hedge fund's Sharpe ratio up until the financial crisis. So the Sharpe ratio is your return to your risk, where risk is defined as volatility. So it's really volatility adjusted returns. And a higher Sharpe ratio, so if you think of it, is a hedge fund trying to optimize for what they perceive to be the return over the risk.
Yep.
And that failed to predict their subsequent losses in the financial crisis. Meaning they had, let's say you had a high Sharpe, 3 Sharpe ratio coming up to the financial crisis. In the financial crisis, you still lost a lot more money.
Okay.
So in fact, it was actually a weak predictor of failure. So some high Sharpes indicated they're more likely to go bust. So you had a high Sharpe ratio coming into the financial crisis, and you were more likely to go bust. Even though if you think of the formula, it's like, wait, I thought you were optimized for return over risk. And that kind of shows you the fragility. What you're doing is maximizing your returns and minimizing your measured risk, but you're maximizing hidden risk. And so the point is optimized systems can be fragile. But let me apply it to stock investing. So where particularly there is fragility for stock investing is, I think a glaring one is, well, how do we know our exact edge and odds, right? So there's
that was going to be my next question.
Yeah. So there's a fallacy of kind of knowing the inputs, right? We don't have the certainty of a deck of 52 cards in a very controlled casino environment, for example. And so what are the probabilities of an asset price moving up or down? What's the odds? They're not given in advance to us. They're not static, if we can even calculate them at all. And then the second fragility, I think the more glaring one is as well is the law of large numbers. Is kind of the engine behind Kelly. Mm-hmm. Our sample size is just insufficient, Rob. So when we invest in stock markets, we have significantly less sequential bets than the casino.
Okay, so you're not playing thousands of hands in a given day. You might be holding on to a stock for like 8 years or something.
Yes, exactly. So the law of large numbers tells you, well, let's say the more you spin the roulette wheel, well, the closer you should approximate the expected time you see red, percent of times you see red, right? There's a fixed probability that you should see red, but you approximate it better the the larger your sample size. So you have a tendency to converge with a larger sample. And you're right, we just don't make that many sequential bets. And that means there's a way more randomness and noise introduced.
Okay. So, lots of reasons to not just blindly follow Kelly. But I presume the reason that you look so much into it is because it's a useful framework, this idea of thinking about edge, thinking about odds. And I also wonder, this maybe plays into the optimization piece, but to what extent do you go down the rabbit hole to try and identify these as precisely as you can versus really just using it as a framework for thinking?
Yeah, so I think we can use Kelly by thinking through it dynamically from a first principle perspective, and less so from a mechanical perspective. I mean, even Ed Thorpe, who famously used kind of Kelly and is an excellent investor with a track record, I mean, he rarely had to precisely calculate it. And so for each investment, we can think through, I think, directionally, what's our perceived edge and what the odds are, with a directional understanding that, well, higher edge, more favorable odds should lead to a bigger position size and vice versa. And then we introduce a red line hedge against our own hubris with a 6% single stock limit, right? So so it's really a finite Kelly bet, right? So there's a restraint on it, and you can apply kind of conservatism to the investment, right, fraction, to the extent that you think the future probabilities are uncertain, right? As if it's more predictable, then you might be able to be like, okay, well, we can get closer to that 6. If it's less predictable, then you might apply more conservatism. And really, this weighting exercise is intractable, right? So if we knew exactly everything, then would you own 100% weight in one stock? But we can talk about the satisficing process later. But that's kind of how we think about it from a first principle perspective.
Okay, and in doing it and applying it to your day to day, you mentioned a couple things to go through, but just what does that checklist look like in terms of, you're never going to get the precise number in terms of your edge or your odds, but what are some of those framing mechanisms that you use or that you go through when thinking about that?
Yes, and we use a decision-making checklist, and it's dynamic. It helps frame the odds for us. And so to be clear, this is kind of a supplement to our diligence and investment process, right? It's not like I do this checklist and that's the investment. So this is not a replacement, but it just helps you. It helps keep you in check. So some questions we ask ourselves: is our edge behavioral, analytical, informational, or technical? So this is the BAIT framework. And the most likely edge more for us is behavioral or analytical. If you think of informational edges, well, a lot of it is arbitraged out. There's proliferation of data, disclosure regulations. And technical edges are unlikely for kind of our style of long-term investing. But let me give you an example. At the time, and we don't know with any certainty but this is what we thought. So Publicis, the number 2 ad agency in the world, we thought perhaps on the behavioral side, there was pessimism on the sustainability of organic growth rates, given some track record pre-pandemic of ad agencies growing. On the analytical side, we evaluated kind of what's the base rates in this business, and then we dug into the mix of the assets, which suggested to us that, hey, maybe there's differences in the quality of the business relative to its peers and its own history, including kind of the cyclicality. And in this case, I know I said technical is not very usual, but we don't know. But it was getting a French company discount. It's a French headquartered company, and it was trading below U.S. peers. But interestingly, Rob, it has predominantly U.S. exposure, right? So 70% of its profit is actually from North America, we think. And so really the exposure is more U.S. based. So other questions we ask, Rob, we ask, what are the base rates for this type of business? So have I considered the outside and the inside view? And what relative weights should I assign to each? So for example, if it's a drug trial, you may lean into the base rates to estimate the probability that the drug, it goes beyond the clinical trials into commercialization, because that's a little bit more luck versus skill-based. So you might lean heavily into the base rates there. We also ask, where is the business fragile? And we're trying to separate kind of small negative risks from terminal ones. So let me give you an example. We own KDDI, right, the number 2 telecom communication company in Japan. And it recently bought a stake in Lawson, which is the number 3 convenience store operator.
Yeah, I saw that. Had me scratching my head.
Yeah, so I love the egg sandwiches in Japan, Rob, but I'm not sure I'm going to get my data package with my egg sandwich. I don't know why a telco needs to own a convenience store, right? It's not very good capital allocation, kind of poor strategic logic. But it's likely a small negative risk. It wasn't really a terminal one. When you think of fragility, it was roughly 5% of the market cap. It wasn't going to plunder the balance sheet. And so something more terminal would be like double trouble, what I call double trouble, which is financial and operational leverage, right? The double whammy we talked about, I think, in the last podcast, for example. Just to give you an example of that, there's 3 more questions. I'll be fast, hopefully give you some examples. Is there an asymmetry or convexity in this investment? So here you can do kind of a reasonable, let's say you can do an upside versus downside handicapping. Can I handicap the downside relative to the potential upside? Maybe there's a mispriced option or a significant margin of safety. For example, Novo Nordisk, right, the number 1 biopharma in diabetes care, it had this obesity optionality that ex ante maybe you weren't paying much for. And so it doesn't
this is going back 3 or 4 years before we all knew about this company.
Exactly. I mean, and look, this is, Ozempic, obviously, it doesn't mean you're going to get that home run from an optionality perspective. Like the option might just expire worthless, but that gives you more asymmetry in the investment.
Yeah.
Am I overconfident? So we ask ourselves that. Have I pursued disconfirming evidence? So Charles Darwin reportedly would write down right away any disconfirming evidence he comes across, because he knows the human mind, how it distorts information. It wants to hide away that disconfirming evidence, right? Because it's not going with my thesis or not going with what I thought. And the last one I'll say is what I call kind of the investment Turing test, which is, do I understand and can I articulate the short thesis? And so that's just something. The more you can understand the nature of the bet you're taking, the exposures you have, I think that's a useful to help kind of frame the odds.
Okay. Can I ask, though? I mean, those who've listened to the podcast and for a while will know about, you mentioned this is a supplement to the rest of our philosophy and process and our investment approach. But I'm just wondering whether you can tie in this checklist, which I presume is designed to ensure that you are slowing down and thinking in Kelly-like terms. How does that compare with the matrix process that we have today, which, in some ways is also designed to help with sizing?
So, I think this comes out, if I step back for a second, it's like, well, how do we know what we know? And so I think as investors, we live in this kind of gray zone between nihilism, so everything is meaningless, and precision, which is like, I know everything. And I think we need to combat that instinct to embrace the gray zone with precision. So, for example, instead of we don't need to add more assumptions to our discounted cash flow to shore up our confidence or valuation. Because for one, we introduce the danger of kind of fooling ourselves and increasing our conviction without increasing our accuracy. And for two, the unintended consequence of that is complexity. So one way of simplifying and going back to basics for more is actually our matrix framing, which, by the way, Rob, in itself is already an abstraction, I'm sure you know. So it's already pretty hard, right? It's hard enough. And so, and the required ingredients, regardless of what you use, is humility and self-awareness. So knowing what you don't know. But let me give you some examples. So you're absolutely right. We have the matrix. There are some things that the matrix can account for, and doesn't mean we should change the matrix. It just means we're supplementing it with additional considerations, right? Let me give you a simple example. Illiquidity is not accounted for in the matrix. So we own a tail position in Bravida. This is dominant Nordic servicer and installer of HVAC, electrical, plumbing systems, etc. And it plots really well on the matrix from a quality and valuation perspective. And it has one of the largest gaps between the theoretical weight that the matrix would suggest to us as a guideline weight versus our actual weight. But that's a technical constraint, right? So we can't get enough position into it. There are also times where the risk management dominates, and the matrix won't appropriately reflect that judgment because it applies a linear weight to risk as one of the three categories of quality assessment.
Yeah.
So
this is where the fragility in your checklist becomes that much more important.
Absolutely. So let me give an example. We own XP, the number one independent Brazilian broker-dealer. And it plots really well in the matrix, and the suggested matrix weight, let's say, right, is higher than the actual weight. But there are some compounding risks of, while there's a capital market cycle, it's in Brazil, so emerging market risks, and there's a black box with financials. And so we likely tap out at a certain risk budget, so to speak, even if the matrix says, go to 6% because that's the quality and at times of business. And that's because the risk may be understated in that particular point, right? So we want to satisfy and we don't want to be optimized in that to be compliant to our matrix, so to speak.
Got it. Can I shift a little bit? Because, and I do want to stick with these more sort of practical applications of Kelly and this theoretical framework. And I think what we're about to discuss next obviously applies to your day-to-day work, which is, figuring out what weight to ascribe to companies in the context of your portfolio. But I imagine this applies to anybody allocating capital, whether it's a client with manager selection and just dealing with new information. One of the interesting things that we've seen in studies is just that over time, and this is not specific to us, this is just kind of institutional investors at large, there's a tendency for their buy discipline to be better than their sell discipline. Is there anything that Kelly offers in explaining that?
I came across a study which effectively said, that the institutional buyer, tend to make great buying decisions, but not very good selling decisions. And they attributed to what they call selling fast and buying slow. And I thought that was very interesting because what it's saying is, hey, maybe we're not allocating as much cognitive resources to our selling decision as we do to our buying decision. And so what there's a tendency for institutional investors to do is, for example, look at the tails of their portfolio, right? So at the end of the portfolio and say, well, this one has been underperforming, and use that as a selling decision.
Okay, so not necessarily the sizing tails. You're talking, hey, I've got this great new buy idea. I need to make room for it in my portfolio.
Yeah.
Well, let me just look at the top third of the portfolio that's been up more than 20% over the last 12 months and choose from among there, as opposed to the better method, which would be to look at the whole portfolio and their expected returns and select from there. Am I thinking about that right?
I think you're spot on, Rob. And so the better quitting decision, so to speak, is, and Annie Duke talks a little bit about that, is, well, what's the expected value? So look through your entire portfolio and look at, well, what's the lowest expected value for this opportunity here? And so we do this process, right? If you think about it, our matrix process is quarterly, so it's dynamic, and we look through all our holdings as we rank them through on the portfolio. But still, we've implemented an additional circuit breaker, and that forces us to consider all of our holdings for sale, not just the ones in the tail. And it's a checklist question, and we love checklists. So we strip out. You could do this in different ways, but we strip out the tails of the portfolio. So these are the ones that, by stock return, the ones that have contributed the most, the top contributors and the bottom contributors, because those are already salient in our mind. Like we know, roughly speaking, those. And then we kind of outline the stocks, what I call in the mediocre middle. And so just say, I put them kind of at the forefront.
Ones that you would just naturally overlook.
Exactly, but just put them at the forefront of our brain, right? Just like, have you considered these for sale when you're thinking of selling stuff?
It's amazing how much of this comes back to behavioral stuff, eh?
Absolutely.
It's pretty incredible. Let's shift to another situation that, hopefully you find yourself dealing more with the former than the latter. But just, what happens when you've got real winners in the portfolio over a long period of time? They're up significantly versus losers in the portfolio, those that have already drawn down quite a bit. What are some insights from your deep dive into how to deal with those types of situations?
Yeah, so that's a good problem to have, Rob. So, so one of the books called Art of Execution talks about one of the kind of make money strategies for having a winner, right? What's the typical urge, right? And you talk about behavioral. What's the typical urge for if you have something that goes up, you want to sell, right? It's going to have itself, whatever it is.
Unless you didn't own it, in which case you probably want to buy it.
Right,
for the FOMO.
Right. or you resent it, right? Like, I don't know. Yeah. I guess there's different reactions to it, but depending on your temperament. But so let's say you own it. One of them, scratching the itch, so to speak, he calls it being a connoisseur. So if you think of a connoisseur, they have all these fine wine aged bottles in their cellar, right? But just don't drink it all. Drink one bottle every now and then. So effectively what it's saying is do a little haircut, trim it, as kind of scratching part of the itch, right? So having a connoisseur approach to that is kind of an interesting way to approach some of your winners. Of course, you don't know if it, the difficulties, you don't know if it keeps winning, right? That's one. And so there is some prudence to kind of trimming and doing some haircut to that. And I think
okay, but provided your fundamental analysis suggests that the business is intact, there's fundamentals are doing well. The connoisseur approach allows you to take some risk off without, missing out on what might come next.
Absolutely. And I think part of it is is a crazy stretch valuation, or the fundamentals are the fundamentals are eroding, then maybe, and it's still winning, then that might be a puzzle you want to solve. I think another mental model is, well, in this connoisseur approach, putting it into perspective of the fundamentals is, am I conflating the cyclical with the secular? Right.
Okay.
And so, is this just a cyclical thing where it's outperforming today because there is a temporary demand supply imbalance, or is this secular, like it's taking market share, it has a long runway, it's cookie cutter runway because it's doing the same thing over and over again within its competence, right? So that's another mental model to kind of apply that, to think about, is this cyclical or secular?
Okay. And what about on the other side? Because I imagine these are the ones that actually cause the greatest anguish, which is, oh gosh, I own this thing and it's down 30 or 40% since I first bought it. What are strategies informed by Kelly or otherwise that have proven to work in dealing with those situations?
Yeah, that's the worst side to have, Rob. So two ways that the book kind of outlines of making money in terms of approach. So this is kind of a money management approach, right? One is being an assassin, and two is being a hunter. So an assassin cuts their losses quickly.
Okay.
You're on the losing approach, and there was a tendency that either kind of at something like a third loss, of the stock, they just cut their losses. They're like, it's not going my way. Now, of course, the risk is you don't give it enough time to play out. And we're long-term investors, so always keep that in mind. It doesn't mean this is not a wholesale implementation of this. This is just, hey, what's the perspectives out there, right? Another reason assassin might cut their losses quickly is, well, Peter Lynch calls it the pig in a trough approach, right? So the bigger pig kicks out the smaller pig in the trough, right? This is where a new idea is better or perceived to be better and kicks out an existing one. So that's another way of considering it. Now, the other kind of, let's call it make money approach in the author's perspective, is a hunter. And so a hunter is, if you think about that, is more contrarian.
Mm-hmm.
They double down or they average into the position. And that requires more patience and discipline. So let's say you have a stock, it's coming down, so you buy, 1/3 of your desired position. And it keeps going down, you buy another 1/3. So you have 3 bites at the apple, so to speak, and you don't put a full stake in immediately. And so that requires a discipline and a patience. And of course, you have the risk of, doubling down, eventually leads to ruin, right? You double down enough times and all of a sudden your bankroll's gone. So
yeah. Okay. And I guess so far we've been thinking about these situations in the context of, a broadly diversified portfolio, but looking at individual investments. I've been thinking of them so far as over time. So it's been 5 or 6 years, and this has just been the trend. But some of these movements happen quickly too. They could happen in a day. Maybe there's a great earnings announcement and the stock just shoots up. Are the approaches different for those intraday movements versus these long-term trends?
Yeah, and Michael Mawer has a great concept. So there's 2 times where you find yourself kind of on the extreme ends of the emotional pendulum, right? And so one is the person is overboard. So you think of, you're overboard in the water, right? You're drowning. And that's when the stock kind of drops in one day, significantly against some type of benchmark. So one day drop of more than 10% against the benchmark, let's say. And then the other side is, you're just ecstatic and euphoric because your stock went up 10 or 15% to get, more than 10%. And they, calls that celebrating the summit. So you're on the top of the mountain, on Mount Everest. And of course, most people die on the way down, not on the way up, Rob.
Yes.
So you're on this Mount Everest and you're on that extreme. And what's useful for these type of scenarios is what it's called kind of the redo checklist, right? From Checklist Manifesto. And a redo checklist is where you read the checklist and you do it as you're reading it. Whereas the other one is do confirm, and do confirm means you're doing the stuff, and then occasionally you check the checklist to make sure you're confirming, like, hey, yeah, I'm on track. And so a redo checklist kind of gives you, in a stressful moment, an ability to take away that emotion and think about it rationally. And so again, this is a checklist Mebusson has on base rates. And the idea is, well, what's the base rate of this stock that's down on one day? Let's say it's an earnings or non-earnings event. And then you go through a series of things in terms of momentum, quality of the business, and the valuation of the business. And of course, as you go through that, you're sacrificing the sample size for a better fitting case.
Yeah.
And as you go through that, it kind of says, hey, 30, 60, and 90 days after that one-day event happened, here's the base rate of what the stock did with this sample size. So let's say there's 50 stocks that dropped 15% in 10% or more in one day against the benchmark with these characteristics. And the base rate is it underperforms in 30, 60, 90 days subsequent to that event. And that's interesting because, again, this is just a supplement to fundamental analysis, right? But what's interesting about it is I've done this before, Rob, and it immediately makes you just think rationally, and like it removes like any psychological kind of damage or anything like that. And you could do the fundamental analysis even better and put it into some perspective or context. Now, of course, our horizon is longer than 30 or 60 or 90 days.
Yes.
Right. I mean, our turnover is 10 or 11% most recently for a global equity strategy. And, we're long-term investors. So, but it's still useful because it might say, hey, don't add, from a timing perspective, maybe don't add immediately.
Be patient. Yeah.
You might have had the inclination, like you're so excited, you're celebrating the summit and you're like, yeah, keep going, momentum, and you become a momentum junkie or something to that effect. And so it just grounds you.
Okay. And I imagine diversification is important there too, because base rates require a larger sample set, as you said.
Yeah, absolutely. And the more at some point, right, this is like only the more you go down the road of, well, these characteristics fitting the case, the sample size shrinks, right? And sometimes to an extent where, well, it's 50. Well, that's, and for how long, right, in that particular scenario. So, but then the more you step back, the less relevant it is to your case. So again, I keep, always there's randomness and noise in this, so keep it always in context. But I find it useful as I've gone through it, grounding psychologically and behaviorally. And there's some intuitive stuff that comes out of that checklist, which we can touch on later.
Actually, I did want to go back to something that was on my mind from what you mentioned earlier. This idea of with losers, there's a hunting strategy, there's an assassin strategy. Can you clarify for me, though, because both seem to be diametrically opposed to one another, and yet both have proven to be successful. Is your point that these are two approaches that successful investors have employed situationally, or that successful investors have tended to exhibit more of one versus the other?
The underlying point is you have to fit your style, your own emotion, your own behavioral biases. So some people will, some make money, managers, so to speak, will tend towards having a more of a hunter style, right? They're more contrarian, they're patient, they're disciplined, they like to average down. And that approach works for them. And some others, have a tendency that they can move off their positions quickly and change their mind very quickly to some degree. But and so both can make money in that scenario. The study kind of showed that the one thing that doesn't make money is being a rabbit, meaning like you just kind of scurry into your hole and you effectively hope that things will turn around. And
okay, so the do nothing approach statistically in that analysis was worse than either the hunter or the assassin approach.
In that analysis, now there are times, by the way, that do nothing is a very, very, very good approach, right? Like it's very intelligent activity, so to speak, because it's really a risk management. You have a risk budget, right? But it's something to keep in mind. And on the winning side, the kind of a losing approach was in that study was kind of being a raider. So it's like if you think about it, it's like the moment you got a little bit of money, so it's winning, you quickly raid that position and you close
They're
it
just
down.
locking it in.
You lock
Okay,
it in
got
quickly, right? And usually raiders were rabbits. So that's probably a pretty toxic combo, so to speak, right? It's like you quickly take away all your winnings, and when you're losing, you do nothing. And so if we go back to our kind of top of the conversation, while stock markets are fat tail, they have a power law distribution. And so if 4% of all listed U.S. equities is contributing all the net wealth creation, you don't want to be a raider when you're also a rabbit.
Got it. Can we wrap up, Manar? We've covered a lot of it theoretical. We've gotten tangible in terms of specific situations, examples. As you look back on this deep dive that you did, what are the real key messages that you take out of it?
Yeah. So the key messages for me really are, look, protect the downside. So think about that paranoid kind of conservatism of the philosophy. Survival is critical. Bet bigger when odds are more favorable. So directionally and not mechanistically. And so think of it from a first principle perspective with, kind of a finite red line hedge against hubris, right? I mean, requires humility and awareness. Diversify, which is another way of taming Kelly, right? Like as you diversify, you want to tame some of that volatility. And hey, we just don't know. We could be wrong. So there is a diversification element. And then be disciplined in your money management. So, have strategies kind of before ex ante. When do you double down? When you shouldn't double down? When do you kind of cut your losses, or are you a hunter? When should you double down? So be disciplined in that kind of money management. And ultimately, I mean, there's more than one way to skin a cat. I've heard Howard Marks say that. There's more than one way to skin a cat. It depends on your style and your philosophy. And so you have to fit your own style and psychology.
Great. A self-awareness associated with as well. Well, Manar, thanks for taking us on that tour. Thanks for sharing all the research that you did. And hope to see you back on the podcast again soon.
My pleasure, Rob. Thank you for your time.